All right. One of the values of recording price action is to go back. If you didn't see something in real time, go back and say, is there something in real time that if I do see it when it happens, it could provide probability of what might happen next? So lows and highs are always interesting spots because there must have been something at the low of the day or the low of a move, the high of the day or the high of a move to get this kind of reaction. If you're looking at the illustration, right? A V-shaped reaction. Well, a lot of what I teach is why does price move in the first place? What will it take? What are we ultimately trying to find? We're trying to find future buyers and sellers because it's future buyers and sellers that are going to move price. Future buyers are going to move future price up because that's what it takes for the price of anything to go up. You need more future buyers than future sellers. Okay. How do we get there? Well, one thing is other people's positions, which we have a sample size over here in this vertical, 2-minute OPP. Every 2 minutes, how many orders were used to open up a long or open up a short, and we track it. Why 2 minutes? Because we want what's relevant to the kind of short time frame, something just changed. See, if you get a bunch of what to come in on the lows is bad if you're short. Just put yourself in a position where you're short, which means you think and you want price to do this. You think it's going to break out through the downside and sell off. That's why you're short. I don't care where you're short from. What would be some things you do not want to happen for the downside to come to fruition? Do you want competition, meaning you're short? Do you want a whole bunch of other traders short? The answer should be hell no. Most people in the kind of early stages of understanding trading would say, yeah, which would be the opposite of what you would want. You don't want a lot of people short if you're short because we talk about this all the time. When you're short, you are a future buyer. Like I said at the beginning, that's what we're trying to predict future buyers and future sellers in order to predict the future price. When you're short, you are a future buyer to cover that short. We all are. At some point, you got to cover that short position. You hope to cover it lower and buy it lower, but if it doesn't go lower, you're still a future buyer. And many people would use what? A buy stop above the market to cover that position for a loser. Nonetheless, everybody could get here pretty quickly. Everybody could get to the point where I get it. People who are short are future buyers. So, yeah, why would I want a lot of future buyers coming to this market if I need price to go lower? Well, what do you get here that might help predict that the upside is the right side in this moment? Not in 5 seconds, 20 seconds, 5 minutes, but in this moment, because it's in the real time where you have to operate to get out of your short position, maybe to get bullish and get into a long position. Either way, it's in the real time that we operate. So if you look at this market come down and it's chopping sideways, and sure, there is a really good chance it gets below here. It's got some downside momentum and follow through because everybody is looking and saying, if I'm long, I'm getting out if it gets below this yellow line. That's what many people are saying. If a fifth grader would say that, it's pretty safe to assume most of the rest of the market would say that. If you show anybody this chart and you said, if you're long, where are you wrong at? Most would say below this yellow line because of the context, the bottom of the range. And so if longs are going to get out, what are they? Their longs are future sellers. So it's okay to think that there could be a breakout to the downside below that yellow line. However, if you start getting too many people executing on that opinion, opening up short positions because they expect that, all of a sudden it creates more future buyers and more future buyers and more future buyers. Remember, this is just a sample size, not just shorts, but shorts versus longs. You have to compare something to something else, apples to apples, in order to find value. We talk about that all the time. How do you find value? Appraisers in the housing market, they compare and contrast. That's the number one tool generally used to find the value of anything. So with shorts, compare it to longs. If there's a lot of shorts, how do we know there's a lot? Well, you got to compare it to longs, and then you could come maybe to that conclusion. Either way, when our laser, that's what we call this, turns red, that means there's more shorts than longs over the last 2 minutes. It's also shown right here. And forget about the white bar next to it for a moment, but that's what it's indicating in this sequence. And again, in real time, because that's where we're executing. There's a reason that if you get right down to it, most people's weakness is real time. Because that's the hardest part, making decisions when the you know what is hitting the fan. And you're emotional. You got to decide to get in, decide to get out, decide to do nothing. So what you're looking for is change. And you need to be at the beginning of change in order for it to provide an advantage. If you're at the beginning, at the very moment that Trump posts something on Truth Social, like halfway through the post or after the first word, that's where the most opportunity is going to lie. If you knew what he was going to say right before he hit send, unbelievable opportunity. A change is going to affect the thing you're trying to predict. At the beginning of it is where the most value is going to lie. So a flip of longs to shorts, potentially creating this V-shaped chart pattern, because you're not going to make any money after it goes up here to say, oh, that was a V shape, that was a bottom, more shorts came in. You have to be able to do it when it's happening. So if we just take the slider here, the market finds a bid and jumps. Now it doesn't just follow through. Some longs come in and they fight. Boom, shorts come back in. Just following red to green, sideways, back to red. Shorts come in and it lifts above our PWAPs, which is generally good resistance until it's not, and then it's pivotal. So there's other factors that could get you to predict the probability was upside. And this was going to, in fact, be this V-shaped pattern afterwards, but now you're being able to put the pieces together when it's happening. And so let's rewind and talk about right in here. Same thing. You see shorts come in this area that could possibly predict a V-shaped bounce to keep you from getting short if you're bearish and maybe to get you long if you're bullish. Maybe. One example, because remember what I said? If you want to get short, you don't want competition. This could disqualify you getting short and getting stuck and having it rally against you. And it's not all the way up in here that it shows you shorts coming in. It's down closer to where you need it to tell you that. If you just look at these raw numbers, 37, 37, 52, 42, 40. I paused it. It was down here, not up here. This isn't always, hey, dummy, what's the matter with you? You didn't see that? You should have been long. Well, most people aren't even putting themselves in a position to see this information. And then there's a whole bunch more people that don't even realize this is an advantage or an edge or data and information they should be looking at in the first place. And then another thing changes and starts to flip, and that's the chaser, what we call the chaser. Let me bring this into here, where this guy right in here starts to show you an imbalance. Like, you know what? There's a lot less people who want to sell it 219 than want to buy it for 38. Now, this is a unique number. It's not just total bids added up and here's what it is. Total offers added up, and here's what it is. There's something more unique that we do to collect these numbers and put them there. It's again not just adding up people resting bids and resting offers. Any dome could do that and everything else. But most of the people who have orders in there aren't real. They're not serious. It's not you or I, or it's not, anybody who might be even listening to this video. It's just markets and all the algorithms and everything else have orders that are going in and out for different reasons. And it's not spoofing. It's legitimate, but they're not real. If they're not real, why are you kind of digesting the information? Because there's a lot of false positives of, oh, look at all the bids. It's got to go up. What you got to get to is real bids and real offers. How do you get there? How do you get to real orders, I should say? Real orders meaning they want to buy it and they want to sell it. When price gets close to filling them, they're not pulling it. Those are the orders that you want to analyze and you want to have thrown at you. And so what we do, and I could disclose this because I've talked about it at length, is that orders that move and get aggressive, meaning they're bidding 38s, now they're bidding 38 quarter, 38 half, they're moving up. If you're a buyer and you're moving your price up, you're aggressive. I don't care what it is you're buying. If you're a seller and you're moving your offer down, you're aggressive. I don't care what it is you're trying to sell. Makes sense, right? You're trying to sell a house and you keep calling the realtor and say, lower it to 500, lower it to 450, lower it to 400. You're aggressive. So we take that, the change in the order, and that it is in fact moving up or down. And that's what we want to track and follow. That's more important to us because we deem those to be real, meaning they're going to participate generally when price gets closer to their order. So a couple things happen down in here. It goes from more longs than shorts to more shorts than longs in this area where it does V shape and rally. And then a nice flip, a few ticks up of real buyers versus real sellers in this area, which just gives kind of more probability that the upside indeed is the right side. And so you see, as I fast forward it, and you see two V-shaped rallies, one right there and the second one right here. And I spent a little longer with this video because it's important and it's the stuff you should be looking at if you record to help you identify it in real time so it doesn't become like, you have to be shook. It just, you start trading what you see and not what you think. It's an old saying. Trade what you see, not what you think. You have to diligently react to the right information in order to have a chance to predict and execute on probability. I often compare it to driving a car. After a certain period of time, you don't have to think about where the brake pedal is, let alone when to hit it, right? You're reacting to training you already have. The problem with this business is overwhelmingly the number of people who never put themselves in front of the right information and know how to analyze it is high. People never really give themselves a chance to succeed at this business, yet they try. And they think they're trying. There's so many stones unturned. And it comes back to the basics and the simplicity of, well, wait a second. If you think it's going to go down, you certainly don't want to see shorts pile in. Be careful. You could be short down in here. There's nothing wrong with that. But they can get the F out if you see shorts pile in that competition. Go to another bar. If you're young and single and you're looking for girls at a bar and a bunch of guys show up, go to another bar. Too much competition. If that's the goal. One thing about day trading is you better get good at being wrong, because that's an important skill. Nobody wants to be wrong. They certainly don't want to be good at being wrong. No. You want to be wrong. That means you're able to take risk, but you're also able to manage that risk. You're not insecure. Problem with a lot of traders, well, which is a lot of people, they hate being wrong. And I get it. Who loves being wrong? Nobody. The other problem is we love being right, hate being wrong. Terrible emotion. You got to detach yourself. Be objective. Look for OPP, other people's decisions. I mean, other people's positions to create better decisions. Maybe that's what we should rename it. ODD, other people's decisions. But that's what we're trying to predict. Future buyers, future sellers. Get down to why price moves in the first place. It's seeking balance. It's seeking areas that it could reach out and shake hands with somebody else. And everybody's shaking hands. That's the chop. That's when you're in the chop. That's when there's buyers and sellers. They're all happy. They're all in agreement in a certain 5 point range. And all of a sudden, there's imbalance. There's imbalance. Imbalance isn't helpful for price to move. It's necessary for price to move. Oh, it would be nice if you in this area found a bunch of shorts that came in. It might be helpful. It's not only helpful, it's necessary. It's what's required for the price of anything to go up or to go down. And most people that have been trading it for a long time can't answer the question, why does price move in the first place? And then what tools are you using to predict that? Because if you're using the tools everybody else is using, or you're coming to get information with or even after others, there's no edge to that. You got to find out when there's a change and then be at the beginning of that change for it to offer the biggest advantage. Is there an edge to know that Trump's Truth Social post, was it 2 days ago, is why we ran up? Would it be important to know it right as that post came out? Hey, would it be important to anticipate he's going to drive this market up or down by a comment and you know it's coming? And if we fast forward and you look at what do you want to see at the top for a potential move up and potential resistance up here, you want to see longs come in. And when longs come in, red to green, the beginning of change, best chance for the market to do what you think it's going to do. And then what's really important also about being more accurate or knowing when it should do it is that if it's not doing what it's supposed to do, man, that's a lot of good information too, isn't it? You got to got most people have to get better tools that will listen and come across me in this YouTube channel. They have to get better tools. And the problem with this trading and this industry is they don't even know what the proper tools might be. So it could be overwhelming and it could be rabbit hole city. And don't think you're unique. It's not the internet that makes it overwhelming. In 1998, the first class in education I paid for, which was not cheap, the three part course was $1,700 in 1998 dollars. Point I'm trying to make is that the education that I bought wasn't always great. That class was actually pretty decent, but it wasn't cheap. Prior to that, I paid $100 for a CME class sponsored by the CME. It was in their building. I worked there also, obviously. And I might as well have been at uh, a union carpenters meeting. There's nothing relevant to trading and understanding why markets moved. Point is that you're going to pay and waste time generally at the beginning of any endeavor. But the goal is to get out of that rabbit hole and at least get on a path you know is the right path. So turn over the proper stones. And generally, people don't get themselves in front of the notion, the idea of other people's positions. And if you were able to get all the information, any information you want this would be the information you would choose. I don't mean a sample size either. I mean, if you knew everybody's position that were day traders, even in the ES, if you knew everybody that was essentially an S&P E-mini trader, generally day traders, right? And you could keep a running total of their open positions, you could put the mouse on the floor and trade with your toes, because the edge and the advantage would be so great. Because now it's no longer a sample size. And so what would you be able to do? You'd be able to pick off turns, changes. We're moving down and bam, bunch of shorts come in. Now you know they got to cover. So your accuracy would be really, really high at turns. Also, remember this, as someone, opening, closing positions, when you get long, let's say you get long at this X, do you think or care if price does this after you get long? Are you like, I'm going to get long and it's going to do this for a while and then go up? You got to have rocks in your head if that's what you think is going to happen. Why wouldn't you wait and buy it right there, right? We all want or expect to get long and have it go up ASAP. It's called timing. Now, it doesn't mean it's always going to have to happen that way, but those are always going to be your better trades. Not just quick winners, but a quick head start where you get long and it starts going in the direction you think it's going to go, pretty close to the moment you got long. And so you look at a chart where you want to get short up here and have it quickly go down, of course. There's some people, this is a much longer video I'm used to doing, but we've covered a lot, but it's all back to the simplicity of why price moves. When someone would be giving kind of an example and say, would you rather buy something at 10 and have it do this for a while and then go to 20? Or would you rather buy it at 13 and have it immediately go to 20? Now, most people would say 10. 10's better. It's lower. Always buy lower. Buy low, sell high. Bullshit. You don't know how you're going to react and what you're going to do when you buy the 10s and you're doubting yourself for that whole period. Generally, you're not on the team for when it finally goes to 20 because of the self-doubt that the life of that trade had by going to 11 to 10 to 8, 9, 10, 11, 11, 12, 10, 11, 10, 11, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. You're probably out for a two-tick winner or a scratch. Or you sold me the 13s and I took it to its final destination.